Hello, I'm Mike DeVries, a partner of the CPA firm of Vanderlecht Mulder DeVries & Elders. Welcome to today's presentation on the benefits of cash balance plan. Depending on a medical or dental practice's cash flow, qualified retirement plan design typically begins and ends with a 401k profit sharing plan, with any supplemental income from the practice then going to the doctor or doctors in the form of an after-tax bonus. Unfortunately, taxes on income to invest after tax can approach 39% for federal income tax purposes. Couple that with state income taxes and the additional 2.9% in Medicare payroll tax, and you're not left with as much money to invest as you are if you were to invest the money pre-tax. Because of the high tax scenario, cash balance defined benefit retirement plans have come into the forefront for medical and dental practices that have significant cash flow and income as a more tax-efficient method of building retirement wealth potentially than any after-tax approach. Cash balance plans are an additional wealth-building device that increases the amount of deductible retirement plan contributions a doctor can make towards his or her retirement goal. Today, Scott McHenry of McHenry Advisors is going to present information on cash balance plans. McHenry Advisors specialize in cash balance and defined benefit plan design and services that meet specific goals of the plan sponsor, and are as simple and straightforward as possible considering government regulatory requirements. I have worked with Scott for several years in coordinating services for my doctor clients. We have talked about wanting to do a webinar like this, and today we're making it happen. So I'm glad to have this opportunity, and I think you'll find this information beneficial. So let's get started. The benefits of a cash benefit plan today on MD Management Group's Fall Webinar Series.
All right, well, let's get started. Thanks, Scott, for joining me today and talking about the benefits of a cash balance plan. You and I have a mutual client, and whenever I talk about cash balance plans to other potential clients that this might be good for, they get kind of glossy-eyed and not really sure what a cash balance plan is. And I don't always maybe explain it exactly the way that you might. And so I just thought if we got online today and we went through what a cash balance plan is and maybe some of the benefits of a cash balance plan for doctors' offices, I thought it would be great. So I'm thankful you're willing to join me today and do this for us.
Great. Thanks, Mike. Thanks for the opportunity to talk about cash balance plans.
Well, we'll let you take it from here.
Great. I think the best place to start is just kind of in an overview of, what I'd hope to talk about, which is just a little bit about what cash balance plans are, who they might be a good fit for, and then go through some examples of a sample cash balance plan or two that we have set up and what they've accomplished for the physicians or business owners. And then just briefly talk about some of the more intricate details of cash balance plans, how we can provide some flexibility in contributions, and how you can make changes to the plan as you go to make sure it continues to meet the goals of the plan sponsor in terms of deductible contributions.
Sounds great.
So I think, the first thing to focus in on is, if anyone's considering a cash balance plan, it's really for two reasons. One, that they can make tax-deductible contributions to a cash balance plan, similar to a 401k profit-sharing plan, but that the contributions that they can make can be of a much higher amount than is possible in a 401k profit sharing plan by itself. So primarily the growth in cash balance plan is driven by tax benefits and a desire to increase retirement savings. This chart just kind of shows what's possible if you're setting up a new cash balance plan for a physician group or a business owner, what's possible in terms of total contributions. And just starting at the left, if you have an individual that has high income and is age 45, in a 401k plan by itself, they could have total contributions of $54,000. So up to $18,000 in 401k deferrals, and then the balance up to $36,000 in company contributions, be it a match or a profit sharing contribution. Mm-hmm. If they had both a 401k plan and a cash balance plan, they could have contributions of up to $149,000. So almost $100,000 more, $95,000 more in deductible contributions. So same tax treatment, the contributions are tax deductible as they go in, and any investment return is tax deferred until ultimately the amounts are distributed from the plan, or more likely they would be rolled over to an IRA and taxed when they're withdrawn from an IRA in retirement. Mm-hmm. And the power just increases as an individual is older. At age 55, if someone was starting a new cash balance plan, they could have total contributions of up to $229,000, which is significantly more than the $60,000 limit that they could have if they had a 401k profit sharing plan by itself. And at age 65, you're pushing almost up to $291,000 in total deductible contributions that would be available with a 401k and a cash balance plan. So that's kind of the power. It allows an individual to really contribute a significant amount in a short period of time towards retirement. And those amounts can stay tax deferred for many years.
Right. And when you think about the tax benefit of putting that kind of contribution away, where doctors are in the higher tax brackets, especially those earning a higher wage, if they were able to live without the higher wage, or maybe they have excess earnings that they could put into a cash balance plan, if not all of this, a portion of it, they would be saving some major tax dollars.
Right, yeah. If we look at, look at the age 45, and if someone is, was doing $54,000 in a 401k profit sharing plan, and we were able to go to them and say, you could do, almost $100,000 more, and you have the cash flow to do it. Right off the bat, they're, depending upon what state they're in, if you just look at the federal highest marginal rate of 39%, they're saving almost $40,000 in current income tax by contributing that $100,000 additional to a cash balance plan over what they were already doing to a 401k plan. So, yeah, very powerful. Just kind of a review of what a cash balance plan is. It's a tax-qualified plan, the tax-qualified defined benefit plan. So meaning that it's just like a 401k profit sharing plan, the contributions are tax deductible when they're made, and the growth of the earnings is tax deferred. In a cash balance plan, each participant has a hypothetical account balance. So generally speaking, if you have multiple participants, you would have just one brokerage account for the plan, but the actual valuation report in the plan document would break the benefits down into the individual level, where each individual would have an annual allocation defined in the plan document. That could be a percentage of compensation. For rank and file employees, maybe it's 2.5% of their compensation,
Mhm.
or $1,000 a year. For the business owner, physician, maybe it's 50,000 a year, 100,000 a year, and on up and higher than that. You can have different allocation formulas for different groups of employees. So if you have two partners and they have different goals as far as retirement contributions, that's easily managed in a cash balance plan. You could have one partner with a benefit of $100,000 and another partner with a small nominal benefit, or even zero contributions. A cash balance plan has a interest credit that's defined in the plan document. So this is what really makes it a defined benefit plan as opposed to a defined contribution plan, is that the benefit grows by a specified interest rate that's defined in the plan document. Could be a fixed interest rate of 3% or 4% a year. There are other options which we can talk about a little bit later of different choices for the interest credit rate, but the important piece is that it's actually defined in the plan document. A cash balance plan follows a lot of the same rules as defined contribution plans, meaning that you have eligibility requirements. We have to do some non-discrimination testing that compares the benefits of the owners of the business or highly compensated employees to non-highly compensated employees. A cash balance plan does require an enrolled actuary, and so that's where my firm comes in. We are enrolled actuaries, and we have to certify to IRS each year that the plan meets certain minimum funding requirements. We talked a little bit about why have a cash balance plan. Really, the big piece is that it has the ability to, for an individual to make a much higher total contribution amount than they could to a 401k plan by itself. It also works very well with a 401k plan. If there are employees other than a business owner, we almost always would have both a 401k plan and a cash balance plan. First of all, the employees really appreciate the 401k plan, but there's also some contribution cost savings, that you can have a better structure of total contributions if you have both a 401k plan and a cash balance plan than you could have with only one plan type. Generally speaking, with a cash balance plan, the rank and file employees would receive a higher total contribution amount than they would with a 401k plan by itself, but that's usually paid for by the tax benefits that are accruing to the physicians or business owners. A cash balance plan is a defined benefit plan, which have been around for many, many years. There's really 5 reasons why they're a lot more popular today and why it makes more sense to do a cash balance plan instead of a traditional defined benefit plan. The first piece is that it's easier for everyone to understand, that their benefit is communicated in terms of a lump sum amount. So if someone's going to terminate employment, they know what they could receive in a current lump sum, as opposed to a traditional defined benefit plan where they receive a benefit statement that promises for them to receive monthly amounts in retirement years in the future. A cash balance plan also is age neutral for employees, so it's a lot easier to manage the overall contribution cost. You can provide the same percent of pay or same fixed contribution amount to rank and file employees regardless of their age. In a traditional defined benefit plan, it was much more expensive for older employees than for younger employees. And there's some ways to have some additional flexibility in your contribution amounts in a cash balance plan than would be possible in a traditional defined benefit plan. I've showed the maximum contributions at different ages. In a cash balance plan, the ultimate benefit amount is limited, and we work backwards from there to determine what is a safe and deductible contribution to be made for an individual. That's really based upon someone's compensation history, number of years that they've been in the plan, and their age. In a cash balance plan, one difference from a 401k plan is that we have to offer an annuity form of payment when someone terminates employment or retires. Most of the time, everyone would either take a lump sum or a direct rollover of their full benefit to an IRA. But they do have the choice to select life annuity or joint life, 50% or 100% survivor annuity. One thing that we look at is that we make sure that we keep our eye on this ultimate amount that can be rolled over after someone has been in the plan for 10 years, and we keep an eye on the plan assets to make sure that the assets are not going beyond the ultimate amount that can be rolled over without any income tax consequences. We showed earlier with the sample contributions what's possible between a 401k and a cash balance plan for an individual of a certain age. For the cash balance component, those limits are phased in over the first 10 years. And so really there's a limit ultimately what can be rolled over out of a plan to an IRA after 10 years. Someone that's age 62, if they've had high income, at least $215,000 of W-2 comp for 10 years, and they've been in a cash balance plan for 10 years, they could roll over just short of $2.7 million to an IRA. So if you have a one person practice and they've had a cash balance plan for 10 years and they're age 62, the goal should be to get the plan assets up to no more than this dollar amount.
For the doctor himself?
Right.
For just the doctor, him or herself, it would just be at that amount, and then, okay.
Right. Yeah, so there is if you have someone that always wants to maximize their contribution and you adopt a cash balance plan, there is kind of a limit of time, 10 years where you can always maximize, but at some point in time, you're going to hit these maximum lump sum limits. And generally speaking, it would make sense to terminate the plan and roll over to an IRA at that point in time.
Scott, would the maximum lump sum limit include the 401k as well?
No, there is no maximum lump sum for a 401k. That limit is what goes in each year. So someone, if they've always had a 401k plan and they had a cash balance plan, they could at age 62 roll out to an IRA $2,688,000 from the cash balance plan. The 401k plan is not limited by that amount. They could have total assets without any concerns that are as much or higher than that in the 401k profit sharing plan.
I gotcha. Now, does this max out at age 62, or does it go up from 62 if I'm going to be in the office for another 3 years and not retire till 65? Does that maximum go up, or does that max cap out at the 226?
It drops down from these limits are calculated by converting a maximum single life annuity pension into a lump sum using interest rates and mortality factors that IRS prescribes. There is a reduction below age 62, and then there's no change in that maximum pension from 62 to 65, and then it starts to increase a little bit. So between if you're looking to really max it out, 62 is kind of the target age if you can have 10 years in the plan by then.
Gotcha.
That lump sum drops down from 62 to 65, and then it starts to increase up after 65.
All right. So this is a plan that you put in place after you have established your other retirement plans. And so it's going to be layered on top of your 401k plan. And you're probably going to run this anywhere from, at least 3 years, maybe up to 10 years, or just depends on how much you want to put away and what tax savings you want to achieve.
Right, correct. Yeah. So, we've talked about the maximum amounts, but it can always be designed for anything less than that, for any length of time.
Mm-hmm.
As far as good candidates, my firm provides actuarial services to about 800 cash balance plans. About probably 60% of those are medical or dental groups or individual, physicians or dentists. And the rest, the other 40% is all sorts of primarily small businesses, a lot of professional firms, sole proprietors or spouses that have a business without employees, other types of small, closely held businesses, as long as there's a right mixture of owners to employees. We also do a fair number of plans for what I call moonlight income, meaning a physician or an individual, maybe a W-2 employee of a practice or a hospital, but they have some other active earned income on the side. And a lot of times that's really attractive. I'll go through, I have an example of a physician that has a side income of $100,000 a year and has kind of had that for a period of time, and then we added a cash balance plan, and they were able to contribute almost 92% or 92,000 now of that 100,000 a year into a cash balance plan. It's almost sheltering it entirely from current taxation.
Nice.
And then some larger companies, sometimes if there's a small ownership group and a lot of highly compensated employees, it's sometimes possible to kind of carve out, a population from a larger company to benefit in a cash balance plan. Here, Mike, is an example of a small physician group. 2 physician partners, 3 employees, and what's kind of possible with what we did with adding on a cash balance plan. The employees or the physicians, the physician that's over age 55 can contribute $24,000 as a 401k deferral. The younger physician could contribute up to $18,000. The employees can make 401k deferrals. I didn't show it here because it doesn't really factor into the overall consideration whether the employee makes 401k deferrals or not. We do a 3% safe harbor, so that's kind of the second contribution column. That is a fully vested contribution that allows the physicians to make the maximum 401k deferrals regardless of whether the employees contribute to the 401k out of their pay or not. The profit sharing column, we're limiting the amounts for the physicians based upon some overriding deduction limits. So we're not getting the physicians up to the total 401k contribution limit of $60,000 if you're over age 50 or $54,000 if you're under age 50. But in total, we're getting them much higher total contributions.
You're getting them to the maximum that you can because it's 229.2, right? Wasn't that the max for someone 55?
Right, correct. So so the physicians are getting $229,000, $149,000 in total contributions. It's costing them a little bit less than 10% of pay for their employees. So $9,215 out of $110,000 of payroll. The physicians are getting 97.5% of the total contributions.
When I look at just
So
a straight, when I look at just a straight 401k profit sharing plan, typically, if it's just a safe harbor plan like you have here, and it's not a cross-tested plan, we will see contribution to the employee of somewhere around 7%. So
Right.
by adding this cash balance plan, we're looking at adding another 1.5% above and beyond what they would do if they were trying to maximize just the 401k plan.
Right, and for that, the physicians have, almost 268,000 or so more than they could in a 401k profit sharing plan by itself, for a moderate contribution cost.
Right, so it's a big win for the doctors if they have the disposable income and are able to put the money away.
Right, yeah.
Mm-hmm. Yeah, I know for the clients that I have doing this, and for those that we invest the money on the accounts, it's a good deal for them, and it's a good deal for the employees. It's an extra little benefit for the employees, and yet it's not cost prohibitive at all.
Right, and again, these are kind of showed at the maximum, towards the maximum of what's possible. But we could always structure it differently. If you had if a physician, wanted to have contributions of 100,000 total, we could structure that.
Right.
Where they have, about 35,000 in the 401k plan between 401k and profit sharing, and then we could do 65,000 in the cash balance plan. Where it's still a lot more than they could do in a 401k plan by itself.
Scott, is the age 45 about where you want to start looking at it with the doctors? I mean, is that about the starting point? I mean, if you get much younger than that, it's really hard to do, or?
No, I mean, it's at any age, you could do more with a 401k plan and a cash balance plan than you could do with one plan by itself.
Okay.
So we do, we do a lot of plans for dentists or endodontists that are, not far, out of school, where they're doing both 401k and cash balance. Sometimes it becomes, you have to look at the cost for the employees. If all the employees are older than the doctors, that might cost a little bit more in terms of what you have to provide to the employees than if they're all, younger.
Right.
But we can do a complementary plan design study, to show that. So I think if anyone has an interest and has the cash flow and the desire to contribute more than 54,000 or 60,000, that it's worth looking at, and show some real numbers, before making a decision. There used to be, before 2001, you kind of could max out one type of plan, but that there was a law change in 2001 EGTRA that kind of did away with that combined plan limitation. Mm-hmm. And so I wouldn't let the age really get in the way of anybody exploring it as an option.
Not only do you have the benefit of putting more away for later, whether that be at retirement or some other point in your life, you might not retire, you might, terminate the plan and do something with this, but it also does the tax savings. But for physicians and dentists, it also shields them from lawsuits as well, does it not?
Right. Yes. If there are non-owner employees in the plan, then it's an ERISA, which is a federal law that governs retirement plan, and ERISA covered pension plan, and it's sheltered from creditors of the practice of an individual. That unless you owe the IRS money or you get divorced, and it can be awarded to a spouse as part of a domestic relations order. Other than that, any creditors of an individual or the business have no access to these funds.
Yeah, that's great. It's something that's often overlooked about retirement plans. I forget that you have a malpractice suit or something and they're coming after you. Well, at least your retirement plan is safe.
Right, correct. Yeah, there's some a pretty powerful creditor protection.
Mm-hmm.
I mentioned this, but this is a real example. A physician, is part of a practice, but also has side income of $100,000 a year for the past 5 years, and does not need that income for current living expenses. So we set up a cash balance plan. They were able to contribute up to $92,000 a year, so 92% of that total income going into the cash balance plan, tax deductible, tax deferred growth.
That's a great. I've got to keep that in mind too. I have clients that will do that and never think about that. And so as long as they have the outside income, it's not really. They don't have any issues. Well, they would if they were a sole proprietor, wouldn't they? They would have issues with keeping their employees out.
Right. Yeah. This was someone that, at least for this side income, did not have employees. It was only the physician.
Let's say you had a group of 5 partners and the one partner had a little side business or a little side income. Would they be able to do that without including all the employees?
If it is not a controlled group or an affiliated service group,
right?
And which I know are technical terms, but there's a exercise that we can go through to determine whether it is a controlled group or an affiliated service group. If it is not, then no problem. You could do that, just for that particular physician and not have to consider the employees of the practice.
Mm-hmm.
A little bit more, detail. We mentioned this. The cash balance plans are hypothetical accounts. So you have one investment account, and then the individual benefits are kept track of separate from that. The plan assets are trustee directed and invest in a single asset pool. So if you have multiple employee participants in the plan, the employees, unlike a 401k plan, don't have participant direction. They just have the benefit that's provided for by the plan. The value of the cash balance benefits are usually not equal to the value of the plan assets. For example, if the interest credit rate is 3%, then your plan assets earn 4%, then the value of the assets is a little bit more than the current value of the benefits, but that's okay. Ultimately, there's adjustments that can be made to the plan as it goes to keep those values close. And then ultimately, when you terminate the plan, if you have excess plan assets, you can allocate them to the participants in a non-discriminatory basis. So I like to, usually what happens is in our earlier example where the physicians had 97% of the total benefits, if the value of the assets are more than the value of the benefits in the plan and the plan terminates, the physicians are probably going to get 97% of any additional assets that are more than the value of the benefits. As a plan goes, if the assets outperform the interest credit, there's usually 3 things that a plan sponsor could do. They could reduce their contribution so that you true up the assets to the value of the benefits. You could amend the plan to allocate the additional assets to participants at that time, or you could make no current change and you have a plan that's slightly overfunded, and you could deal with it in a future year or when you terminate the plan. On the flip side, if the plan assets earn less than the interest credit, you can increase your contributions to make a true up. you could amend the plan to reduce future allocations to allow the plan assets to catch up. So we had a lot of cash balance plans, and after the stock market, 2008 or 2007, it was down significantly. We had plan sponsors that amended their plans to reduce the allocations for the next year. They made the same contribution that they were planning on making, and by doing that, we were able to get them back up to 100% funding. Or you can make no current change. A plan that's slightly underfunded is not problematic. The owners of a business, generally speaking, if you terminate a plan and it's underfunded, the rank and file employees have to receive the full value of their benefit, but the owners can elect to receive a lesser amount on plan termination, so that they are never required to fully fund their own benefits.
The key there is that it's flexible, right? I mean,
Right,
there are a lot of flexibility to manipulate the plan to make it work the way we'd like it to work, for the benefit of the doctor and for the benefit of the practice as a whole.
Right, yeah. There's we can make change. I think the takeaway is also you can make changes. If you set up a plan for a specific contribution amount and the contribution goal changes, that's fine. We can amend the plan to change the benefits as we go, and you can make changes to what the plan sponsor is going to contribute. Or if something gets out of line between the plan defined interest credit and the actual plan asset return, we can make changes to the plan to adjust for that as well. And these slides are a lot of the same thing. That we can use the 401k and the profit sharing for contribution flexibility, but we can also amend a cash balance plan either to increase or decrease as the plan goes. One thing to keep in mind is that when you start a cash balance plan, and then when you terminate the plan, if you keep a plan for 10 years or more, you do not have to have a business reason for terminating the plan. If you terminate a plan within the first 10 years, there's a requirement that there be a business reason for the termination. There are any number of ways that you can show, if ever audited, that there was a legitimate business reason. If you have a physician or an owner that's retiring, or you expect income to decline, or the costs, either for employee benefits are too high. Those are all legitimate business reasons for terminating a plan. Historically, over doing this for over 20 years, I've never really seen IRS ask any questions about the reason for termination if the plan had been in existence for at least 3 plan years. That doesn't mean that a plan sponsor has to make contributions for 3 years, just that you keep the plan in existence for 3 plan years.
Mm-hmm.
There are, generally speaking, we usually, for an interest credit rate, there are some plan design considerations that we look at when we're setting up a plan. A lot of times we're looking for the lowest interest credit rate that we could use in a plan, because that helps with non-discrimination testing. Sometimes we have to bump it up to make sure that it's providing what the IRS considers to be meaningful benefits to enough participants. There is a new option available. There are final regulations issued in 2014 which allow a cash balance plan to credit the actual rate of return on plan assets. And so we're doing this a lot of times for practices that may have several physicians or a larger medical group. There are two, I guess, caveats when we do that, is that we would use an annual floor of 0% on the interest credit and a cap of 5.5%. So if the plan assets return between 0 and 5.5%, and the plan sponsor makes a contribution equal to the plan defined allocation, there's never any over or underfunding. As we talked about, the over or underfunding is easy to manage, but you can do away with having to manage it if the plan assets fall in that range and you have this plan design. If you have that plan design and the assets return falls outside of that range, then you really have the same options that you have with every other cash balance plan for managing that. We do this for a lot of kind of the larger scale physician groups or law firms, and it's kind of been a newer option since 2014.
Mm-hmm.
This is an area, Mike, that you have expertise in, but that we, as actuaries, I get the investment allocation.
Mm-hmm.
Sometimes it makes sense for a cash balance plan to be conservative. I don't think that is always necessarily the case. So if there's an individual that's a physician that's setting up a cash balance plan, and they, generally speaking, would want to be aggressive with retirement funds, I think sometimes that's okay. There are
Oh, Scott, we lost you.
all right, hear me now?
Yep, I can hear you now. So maybe if you start with a slide over again.
Sure. We, as actuaries, get asked about asset allocation for a cash balance plan. Sometimes it's important for a plan to be allocated conservatively. For example, if the assets are starting to get close to the maximum lump sum limits, I think it's important for a plan to be conservative. But if that's not the case, I think a lot of times it's okay to be somewhat aggressive with cash balance plan asset allocation if you have an individual that otherwise would want to be aggressive with retirement funds. I think the important thing is just to kind of drill down a little deeper into the cash balance plan to see if there's any actuarial concerns with being aggressive.
Mm-hmm. My only concern there, I suppose, would be if you have a doctor who is, older in age, looking to put a lot of money away and getting the tax benefit. So, you take what I consider maybe unjustifiable risk, to get the higher returns, and maybe you don't necessarily need it. You want to keep the cash balance plan maybe a little more conservative than what you might with your profit sharing plan, and protect that too for the employees. So if something should happen and they quit, you got that there. You're not taking negative return and still have to pay them out at the accredited amounts. So like you say, it's going to be dependent upon the situation and who you're dealing with.
Right. Okay. The cash balance plan, if there are employees other than the physicians, it usually makes sense to have both a 401k plan and a cash balance plan, and a cash balance plan by itself. A lot of times, the design is going to look similar to that earlier example, where the employees are going to get at least 5% of their pay in the 401k plan in company contributions between safe harbor and profit sharing. There'll be a nominal benefit for the employees in the cash balance plan. And then we test the two plans together for non-discrimination testing. For vesting purposes, the profit sharing component can be vested over up to a 6-year period. A cash balance plan is required to be fully vested after 3 years.
Mm-hmm.
There are sometimes, if you have a large group, where it may make sense to exclude some employees from the cash balance plan. For smaller groups, it doesn't really make sense because you're going to end up at the same contribution level between the two plans. But if you have a medical practice, where you have over 50 physicians, sometimes you can set it up that only the physicians are in the cash balance plan, and then all the other employees are in just the 401k profit sharing plan.
Mm-hmm.
If you have a larger group, over 25 participants, it's required to make annual premium payments and a filing to a government entity called the Pension Benefit Guaranty Corporation, or PBGC, which ensures pension benefits if a plan sponsor has an underfunded pension plan and goes into bankruptcy, that PBGC steps in and pays the pension benefits to employees. And again, for a medical group, it would only be required if there are over 25 participants in the plan. This is, I guess, a little bit more advanced topic, but that $2.68 million rollover, what you can roll over to an IRA at age 62, that's if you take a lump sum. It's based upon an interest rate of 5.5%, which is kind of difficult in recent times to achieve in guaranteed income. So if you have a cash balance plan and a plan sponsor is getting close to that, sometimes we have the conversation, do you want to roll all of it over to an IRA? If you do, then it's time to terminate the plan and do that. If you are open to splitting your benefit and rolling part of it over to an IRA and purchasing a single premium annuity to guarantee income for life as part of it, then you can continue to fund a plan beyond that point without tax consequences. So, for example, if you had someone age 62 and has $2.68 million in a cash balance plan, option one is you terminate it and roll over to an IRA, and if they're still working, they can do just the 401k plan from that point forward. Or you could split the benefit, and this is a current kind of situation. You could roll over $1.5 million to an IRA, and you can elect a joint and 100% annuity for the remaining benefit, which would be about $1.88 million. So together, between the rollover to the IRA and buying an annuity, you could fund the cash balance plan up to $3.38 million. About $700,000 more in deductible contributions. And really the difference is that the IRS, when you convert the pension benefit limit into a lump sum, you have to use 5.5%. If you go to any insurance company and want to buy guaranteed income, that's going to be based on a much lower interest rate in today's environment.
Mm-hmm.
And sometimes if there is a life insurance need, it is possible to include life insurance and a death benefit above and beyond the retirement benefit in a cash balance plan. It has to be the right fit for the physician, but sometimes there's some great benefits of doing that. First and foremost, that the contributions are tax deductible and are paying for permanent life insurance with tax deductible premiums or assets from the plan going to pay those premiums.
If that life insurance is inside of that plan, then
right.
Say you get a 45-year-old doctor and they're getting some life insurance in there as well, and they pass away at a very early age, at least protects the family some as well, and you deducted the insurance dollars and the premiums from that, right? And
right, correct.
Family stands to benefit with a decent amount of money for the retirement that the doctor would have had if they were able to put the money away during their longer lifetime.
Right. Yeah. I mean, that's the idea is that you're, not only do you have the loss of income, but you have the loss of the ability to save for retirement on that income.
Right.
So that it helps kind of self-complete the family retirement planning. So I kind of look at it as if there is a life insurance need and you're looking into that and you have someone there is a cash balance plan in place or they're considering it, that it's worth looking into, with the difference being that you can pay for it with tax deductible contributions inside the plan where you couldn't outside of a cash balance plan.
Cash balance plan, in addition to planning for, say, a family disaster, also could be used for a way in which you buy out a particular doctor out of the group as well, could you not?
Oh, sure. Yeah, you can. A lot of times we use cash balance plans, kind of in conjunction or planning for a business transition. Certainly, I mean, because there's some, if you, are just bonusing out or paying in W-2, the corporation is paying, Medicare tax on that, and the individual's picking it up in current income. If you put it in a cash balance plan, you right off the bat have Medicare tax savings for everybody.
Right.
And and then the physician, is then picking that up in current income, and those amounts can be deferred for many years.
Sure. And I mean, it's a way that can be done. It would also be something that would have to be talked about strategically because it might involve the other partners taking less pay during the year in order to give the senior doctor a little bit more in their cash balance plan, but counting it towards maybe an overall buyout arrangement that you're going to have for the group.
Yes, correct. That's I see a lot of funny things that cross my desk from different retirement plan promoters. So there's a couple things just to watch out for. If you ever see something, I am more than happy to take a look at it and give you my opinion on if it's a kosher plan design or not. That's kind of all, Mike, I had as far as a prepared presentation. I'm happy to answer any questions or if anyone has any follow-up, I'm happy to get back to them.
Yeah, well, thanks, Scott. I really appreciate it. I would encourage anyone watching this webinar today to put in your questions if you have any in the question dialog box that we have available there in the webinar, and we'll get back to you on those questions that you might have. Also, if you want to consider looking at this, feel free to contact me here at Vanderlicht Moeller DeVries and Elders, 616-949-9030, extension 12. I'd be happy to talk to you and work with you and gather up information, talk about it initially, and then talk with Scott about doing as he said, a complementary hypothetical. We've done that for a few groups now, and we have some physician groups that are using the cash balance plan, and we work very closely with Scott McHenry and McHenry Advisors, we enjoy the relationship, and it's worked well. So really appreciate it. Met Scott at a National Society of Certified Healthcare Business Consultants meeting many years ago, and I think over the meeting there that you were at, Scott, we talked a little bit, and I said, man, this is just something that we've got to do for our clients. And not everybody, it's not for everybody, that's for sure. I mean, some people don't have enough disposable income to make it work, and others just, aren't ready to do this sort of thing yet, but we want to make it available, educate people so that they know that this is available and can afford them some great savings and taxes, and especially with, you think about not only the regular tax, but the surtax that's out there, has been for a while. You save all that when you take that excess money and put it into a retirement plan. So with that, Scott, thank you very much. I appreciate it, and we'll definitely be in touch.
Great. Thanks, Mike.